Okay, so hi all. Are you able to listen to me? If you are able to listen to me, please confirm in the chat so that I can start the PPT, start the webinar. Okay. Okay. If there are any connectivity issues in between, you can just put a question in the question tab. So I am now going to start. Again, a formal hi to all. Today we are going to have a session on understanding income statement, which is one of the main topics of FRA in CFA Level 1 exam. So first, a basic introduction about us. EduPristine, it's a leader in training for finance. It's an authorized institute. It's authorized by CFA Institute, CARD for FRM and the PRM Institute. And we have several big names. We serve them like JP Morgan, Bank of America, and IIM Calcutta. Now a basic introduction about me. I am Sandeep. I am in the content development team of EduPristine. Today, I hope to help you all through my webinar on understanding income statement. Any connectivity issues, please put in the questions tab. Just confirm, is it okay? So that I'll start with the session agenda now. Okay. Yeah, right. Let's start with the session. So today's session agenda, basically we'll start with the introduction to income statement and its components, and then we'll move into the components, how they are valued. The first important component is the revenue. So we'll deal with the principles of revenue recognition and then discuss a question on that. Then we'll move on to depreciation, inventory, and finally we'll look at the EPS and diluted EPS calculations, which are used to determine the performance of the company. So let's start with the introduction. Income statement, it's also known as P&L statement, as you know, and it's the basic equation that governs the income statement is this: revenues minus expenses is equal to net income. Let's go through each of the terms. First, we have the revenue. Revenue, we can show it as gross revenue or net revenue. Let's understand the difference between these two through an example. Suppose you have a salesperson who bought a ticket from somebody at say some 9,000 and then he sold to somebody else at $10,000. Then in gross revenue, what he'll report is, he'll report 9,000 as his expenses, 10,000 as his revenues, and remaining 1,000 as his net income or profit. However, in the net revenue reporting system, what he will do is he'll simply report 1,000 as his revenue, no expenses, and the net income or profit is again 1,000. So in net revenue, basically what we do is we net off, we remove the extra things that are there. Next, we'll move on to the expenses. Expenses, they can be grouped based on function or based on nature. First, based on function, what we do is, here there will be manufacturing expenses, there will be administrative expenses. We group all the expenses related to one function under one thing. For example, the labor expenses, the raw material expenses, and other direct expenses are included in manufacturing expenses. The ones that are used for advertising, they come under advertising expenses. The ones that are used for administration purpose, they'll come under administrative expenses. Now we go to the other classification, which is by nature. Here we have the different expenses based on their names. Simply, the depreciation expense is separate, the R&D expense is separate, The raw material expense is separate, the labor expense is separate. Here we don't do any kind of grouping. They are just based on what work they do. Now finally, the other components in the income statement are gains and losses. These gains and losses are not related to the normal business activities. They are something extra. For example, you have a land and you sold it and you gained something extra which is greater than the book value. Then it's a gain for you. Those things are reported in the income statement as gains. And in the similar way, if you lose something, if the sale value is less than book value, then they are recorded as losses. So let's move on to the next. Here we see the presentation formats of income statements. There are basically two formats. First is the single step format, where you simply write all the revenues, you club them as single revenue, you club all the expenses as expenses, and then the difference between them gives you the net income. In the second step, which is most commonly used by all the companies, we have multi-step, where we start with the sales revenue, then we subtract the cost of goods sold, which is mainly the costs incurred for the manufacturing of the goods. From this we get the gross profit. Next we subtract the administrative expenses and other operative expenses to get the operating income. Next we subtract the income tax expenses, the interest expense, etc. to finally arrive at the net income. First we have the income from continuing operations, which is the operating profit minus the interest expense and the income taxes. And then we'll have some discontinued operations. Suppose you have stopped a plant. Suppose you have stopped operating a machine. The earnings that you get from that, those are included in the earnings from discontinued operations. They are finally included to get the actual net income. So here you can see the sample income statements. The first is the single step and the second is the multi-step. Simply see, in the single step you have revenue and expenses. Very simple. I'll mark some things for your understanding. Here revenue you have, expenses you have, and that gives the profit, the difference. In multi-step you proceed with the sales, you subtract the COGS to get the gross profit. COGS is the cost of goods sold, and then you subtract the selling and general administrative expenses to get EBIT. Depreciation is also subtracted. Depreciation, we'll see all these terms in detail later. The sales term, the cost of goods sold term, the inventory, the depreciation, everything will be explained in detail later. This is the earnings before interest and tax, or the operating income. Next we subtract the interest and the taxes to get the net income. So let's move on. At this point I would like to check whether I am clear to everybody. You can just confirm by writing on the chat box or in the question tab. Okay. Okay. So yeah, basically the responses show that it's pretty clear. Now we move on to the first component, which is the revenue component. This is the most important component in the income statement, and we start with this. Now let's see how it's valued in the income statement. First we look at the definition. It's simply defined as income is something which increases your economic benefits. It either results in the increase of assets or the decrease of liabilities. Assets are something which you have and liabilities are something which you have to pay. Basically income, it's obvious to all. It's the flow of inflows. The important thing here is income is a broad concept, and it also includes gains or losses that we said that occurs from non-operating activities. So income is basically revenues plus the gains or losses. Revenues are simply what we get from revenues or sales, are simply what we get from the operating activities, the core activities that you do. The gains and losses are all the non-operating activities, and we add all these to get the net income. How to recognize revenue? The important thing is here, revenue is recognized when it is earned. What this means? It means that it need not necessarily be at the time of cash exchange. It is recognized when it's earned. The guidelines for this, we'll look at each of them. The most important thing is revenue is recognized when the risk is transferred from the buyer to the seller, from the seller to the buyer. So the ownership risk, when it is transferred, only then immediately the revenue is recognized. It may be before the cash exchange, after the cash exchange, or at the time of the cash exchange. And then there are some conditions which have to be satisfied, which is you have to be able to reliably measure revenues and the costs associated with it. And then the last important thing is you should be reasonably certain that the economic benefits will flow to you. That is, the revenue that you are expecting, you should be reasonably certain that they will come to you. So let's look at an example to make you understand better. Here the situation is basically there's a company which allows some customers to buy on credit. There's an electronic goods company, and to buy on credit, what they do is first they do a background check to gauge the credibility. Here's a situation where a customer ordered a laptop in August, and then the goods are shipped and delivered in September, and the payment was made in November. So here the important thing is when to recognize the revenue. This question is very similar to the question that you can expect in CFA Level 1 exam. So the questions are on par with the CFA Level 1 exam. So here, what do you think is the appropriate month? You can answer in the chat box if you want, if you have understood the concept. I'll move on to the solution in some moments. Here, one person, actually many of you have answered that it is August. So here's the catch. Let's look at the solution. Yeah, Rohan got the answer correct. He says it's September. Let's see why it's September. So here's the solution. The answer is September. Congrats, Rohan, for getting the answer right. And Sakina also got it right. Here the explanation for this is, as I said, one of the principles is the ownership risk should be transferred, and only then revenue can be recognized. So here, although the customer ordered in August, the ownership risk is transferred only in September when the goods were delivered. However, the cash was obviously not paid. It was paid in November, but still the revenue is recognized in September. Also, another reason for recognizing the revenue in September itself is because there is a good probability of future flow of economic benefits. Because the customers have been already tested by the company and the credibility has been gauged. And only those customers who have good probability are given the facility. So September is the right answer. Now we have long-term contracts. How to recognize revenue in long-term contracts. Before this, I want to confirm whether I am audible to everybody, whether there are any connection issues, just put it in the chat box. Okay. So yeah, I'll continue. Now for the long-term contracts, basically there are two methods to recognize revenue. First is the percentage of completion method. The long-term contracts, basically they are for the companies which are engaged in construction projects, because they have projects which extend for more than 5 years, 10 years or something. So here, if the first method that we use is percentage of completion method. Here what we do is simply, if you expect the total income to be say 1 lakh, then after 1 year you see the costs incurred till now divided by the total estimated cost. That gives you a percentage of completion. And then if you suppose the costs incurred are 20% of the total expected cost, then the amount of revenue that you recognize is also 20% of the total revenue that you expect. So here in this case, the revenue that you record is 20% of 1 lakh, which is 20,000. So basically here, the revenue, expense and the profit are recognized based on the percentage completed. However, in the completed contract method, what we do is we recognize revenue only after the contract is completed. We don't do any percentage completion, no calculations, nothing. If you take the previous example, the 1 lakh revenue is recognized only after 10 years or 5 years or whatever the project duration is. Nothing is recognized after 1 year or after 2 years or say after 3 years. That's the basic difference. When do we use percentage of completion method? When we can recognize the revenue and cost reliably. We can measure them reliably, estimate them reliably. Suppose, so in projects where you know that this will be the revenue, where you can forecast with a reasonable probability that this is the revenue and this is the cost, then you use percentage of completion method. However, if you are not able to do so, then you go for completed contract method. This is generally used for short-term projects where you are unsure of them. And in case of revenues, you do this, but however, if you have some losses, say, then you have to recognize it immediately. This is based on the principle of conservatism. In conservatism, what we do is we try to show our net income as low as possible. So we recognize revenues as late as possible and we recognize losses immediately, even if there is a slight chance of a loss. So when we compare the two methods, we can see that percentage of completion method is more aggressive. Aggressive because here we recognize revenues very early. Because in completed contract method, we only recognize at the end of the duration. Here we keep recognizing after 1 year, after 2 years, etc. So when you calculate the present value, you must be doing of the net present value, where a rupee today, is more valuable than the rupee tomorrow. So based on that, revenue recognition early is more aggressive. And in percentage of completion method, you require a lot of estimates. So there subjectivity comes in, your judgment comes in. So that way it's slightly less perfect. However, it actually provides a smoother earnings and better matching of revenues and expenses. This matching principle, I'll go through it more in expenses. What it basically says is, if you recognize revenue today, you should also match the expenses related to that revenue on the same day. Now, however, what we see is cash flow is same under both methods, because cash is nothing related to not related to revenue. cash recognition is different and revenue recognition is different. This is what I underlined to you before also. So now again I would like to see if I am audible, if there are any connectivity issues, anything. Just confirm the chat box. Now I will go to the expenses recognition, which is a new topic. So before that I would like to confirm. Okay. Okay, the responses show that I am audible. Okay, let's now move on to the expenses recognition part. Till now we have seen the revenues. Expenses are simply the opposite. They cause a decrease in economic benefits and they cause cash outflows, or they cause increase in liabilities, or they cause depletion of assets. It's simply the opposite. Here, as I said, we have the matching principle to recognize expenses. Whenever you recognize revenue, the matching principle says that the associated expenses should be recognized in the same period. So here's an example. If you have purchased some inventory in the fourth quarter of 2008, say, however, the goods are sold in first quarter of 2009, then what matching principle says is both the revenue and the cost of goods sold are recognized in the first quarter when you actually sell the goods. Although you purchased the inventory in fourth quarter of 2008, you don't recognize it then and there. You only recognized along with the revenues. Okay, let's move on. The most important, one of the most important expense is the depreciation expense. Depreciation, why do we actually depreciate assets? The simple reason is when you have long-lived assets, say you have a plant, you have a machine, they provide benefits not just today but for different periods, say 5 years, say 10 years. So the costs incurred on the machines should be matched with the revenues over all the periods. So hence, suppose I get some revenue, say 1 lakh today, some 50,000 tomorrow, some 25,000 after 2 years, something like that. So we have to match costs according to that. The difference between depreciation and amortization is that depreciation we use for tangible fixed assets, say plant, say equipment, say machine, and amortization it's used for intangible fixed assets. The examples are patents, copyrights, where you patents basically you have for some specific duration. So we amortize the patents as we move on towards the deadline. Here the important thing that you have to remember is land is something which is not depreciated and goodwill is the non-intangible asset which is not amortized. They are the exceptions to this rule. Because land is anyway, you have the land, it's not like the land goes off or something, or some part of land is going off or something. However, in case of machine or plant or something, the machine after usage it becomes less efficient. So there we have to use the depreciation. Impairment is something which we use for long-lived assets which have infinite lives. For example, goodwill. Goodwill doesn't really have any duration. Goodwill is something which is excess of the book value. So this is not amortized. This is only checked for impairment once a year or once 2 years or something like that. Okay, let's move on. Again, to be clearer, we'll have an example on the depreciation. Before that, we have the depreciation recognition methods. These are two methods of depreciation through which we calculate depreciation. First is the straight line depreciation. In this, we allocate equal amount of depreciation every period. Suppose you have a plant whose life is expected to be 5 years, then you give the same amount of depreciation every year from year 1 to year 5. So here, the way you calculate straight line depreciation is to subtract the salvage value, which is the value of the asset once the expected life is completed. Like once the machine is used for 5 years, the value it gives if you sell the machine, that's the salvage value. So you subtract the salvage value from the cost and divide it with the expected life. This gives you some value which is the same amount used across all the periods. However, in accelerated method, what we do is we allocate more depreciation in early periods and less depreciation later. Why do we do this? Because in general, an asset gives more revenues early on in its life and hence will also have more expenses, will also need to have more expenses allocated to it in the initial part. This is what the matching principle says and we are simply following it. So accelerated method is a conservative method. Why do I say it is conservative? Because obviously you recognize more expenses which causes low net income and hence showing low net income means you are conservative. So the different methods of accelerated method of depreciation are declining balance method, where you have a constant rate of depreciation, say 20%, say 10%, and you suppose the total value is 1 lakh, you use this 10% to calculate depreciation every year. So the first year it is 10% of 1 lakh, which is 10,000, and the next year it is 10% of 1 lakh minus 10,000. So in this declining balance method, you have several methods. The most popular among them is double declining balance method. Here what we do is simply double the rate of straight line depreciation. The formula used to calculate this is as shown. Here what we do is twice the cost minus accumulated depreciation by expected life. It is the point to note is we don't explicitly use the salvage value or the residual value in the calculations. But the depreciation, it ends once the estimated residual value has been reached. So suppose the salvage value is 10,000 and the cost is 1 lakh. So we keep depreciating the asset until its value becomes less than 10,000 or equal to 10,000. So here's an example. There's a company which bought an equipment worth 1,20,000 and it's expected to last for 8 years. So here we have the expected life and the cost of the equipment. Again, this question is on par with CFA level 1 questions. Here we have the salvage value, which is 20,000. So what they are asking is to calculate the depreciation expense in the second year using double declining balance method. I hope you are trying to calculate it. Come on, let's try to do it and let's see who will answer first. Type the option which you think is right. I'll wait for some time for your responses and then proceed to the solution. Okay, I'm getting the answers. Andrew Joseph says it's B. Andrew Joseph has got it right. Okay. Nice. Okay. So let's move on to the solution now. Simply, here the explanation is we use the formula that we showed here. Double declining balance depreciation is basically calculated using this formula. So that's what we do. The expected life is 8 years. So here the expected life is 8 years, the value is 1,20,000, and initially there is no accumulated depreciation. So what we do is we calculate this way. So first year depreciation is 30,000, and then for the next year we proceed the same way, and here we use the accumulated depreciation as 30,000, which is the depreciation expense of the first year. Thus we get the value 22,500, which Andrew Joseph got it right. Congrats. And then for the third year we can even proceed this way. The accumulated expense, depreciation expense, will be 30,000 plus 22,500, which is 16,875. You can go on until we reach the salvage value. So here's a small example to help you understand. Now we move on to the next topic, inventory recognition. Again, I would like to confirm whether I am audible. Are there any issues? Just post it here. Okay. Okay. So let's move on to the next topic then, which is inventory recognition. What is inventory? Inventory is something which you have in store. After selling, suppose you manufactured 100 items and you sold 70. Then the remaining 30 are called the inventory that you have in store. Why is inventory important here? Because inventory helps you calculate the cost of goods sold, which is the cost associated with the manufacturing. So here there are basically four methods I should say, to recognize inventory. First is the specific identification method. Here what we do is we have some identification numbers of the goods. Say you have some 10 goods and you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 as their identification numbers. Then you can simply see which goods are sold and which goods are in inventory. Say 1, 3, 5, 7. पहले 11-12 लोग थे। हाँ 10 लोग थे। हाँ
क्या बोल रहा है? क्या बोल रहा है? अच्छा बना के इसको
ओके, शो में स्क्रीन आ रहा है।
क्या कर रहा है?
हेलो, am I audible now? Hi all. Hello. All the participants, please confirm if I am audible now, so that I can proceed forward. There seem to be some technical issues. We have sorted them out. Now, okay. Please confirm if I am audible now. All the participants. Okay. Okay. It seems that the issues are solved. This is the thing with these sessions. There seem to be some technical glitches. Okay. Now let's proceed forward. We have discussed the example on depreciation, and now we have inventory. In this, we have already discussed the specific identification method, and now we'll move to the concept of early purchases, because we have the beginning inventory and the cost of early purchases, and the cost, since we assume that the first item is the first item sold, the costs of the selling items are also the first items. And the inventory, the ending inventory, consists of goods which are purchased more recently. So when do we use FIFO? It is used when the inventory has a limited life. For example, vegetables, fruits, anything which has limited life. So if a company deals with something like vegetables, it will sell the oldest inventory which it has first, so that the inventory which it has on hand will be fresh to sell in the future. Now the second method, which is the LIFO method, is used. It's the opposite of FIFO. Here the last item which is purchased is assumed to be sold first. So here the cost of goods sold consists of the items which are purchased more recently, and inventory consists of items which are purchased very early, including the beginning inventory. This is appropriate when you have goods which are not perishable. Any goods except the perishable goods. Say a mining company, it sells its goods. The items which are on the top of the file, it sells them first. So in that way, it is selling the items which are recently purchased. So the cost of goods sold consists of the items which are recently purchased, and inventory consists of the items which are there from the early stages. The weighted average cost, it's the midway between these two methods in one way. In this, the flow of the inventory, it doesn't take into effect, and it is not affected by that. And here both the cost of goods sold and the closing inventory are calculated using weighted average cost. What is this? To calculate this, what we do is, first we take the total cost of goods divided by the total units that we purchased to get the cost per unit. Now suppose you bought 10 units at $5. Now you sold 7 goods. Say at a later stage you purchased 5 more goods at $15. Then what you do is, anyway we'll have an example to illustrate this. This is actually popular, this method, because it is very easy to use. The calculations part I'll better explain using the example that we have next. So this table is basically the summary of all the methods. In the FIFO method, the cost of goods sold will have the initial purchase and the ending inventory has the recent purchase. For LIFO, it's the opposite. And in the weighted average, we have the average for both the methods. How are these calculated? Let's see an example. Here we have a company which made the following transactions. The purchase and sales are as shown, and there is some beginning inventory which is 15 units. The question asks us to find the year-end inventories using both FIFO and LIFO methods. Again, this is a question which is on par with CFA Level 1, and you can expect very similar questions in your exam. Let's see if any of you can solve this. Again, try to solve the question based on what I explained earlier on. Let's see if anybody can get this right. Meanwhile, please respond if you have any connectivity issues, if you have any problems related to the connectivity. And try to answer the question. We'll soon discuss the solution and the methodology used. Just write the option that you think is right. Okay. Okay. So Himonk got this right. Himang, congrats, he got this right. Now let's move on to the solution. The solution is the last option. And how did we calculate this? Using the FIFO method, what we do is the initial goods that we purchased are the initial items sold. So here we purchased a total of 50 plus 30 plus 60, which is 140 units. And then let me show you. Okay, total we have 140 units here purchased. And then the item sold is 20 plus 25 plus 30, which is 75. So the remaining 65 items are your inventory, ending inventory. So now we move on to the valuation. Using FIFO, the 65 items in the ending inventory, what we say are the last items that we purchased, because the cost of goods sold is the initial items and the items purchased are the last items. So the 60 units that we purchased at $60 are the items used to calculate ending inventory. So here, this is what we did basically. 60 into 60, this is the last units, and the 5 other units, we take the transaction just before this, which is at $30. And we add the beginning inventory to this. So this gives you 3,600 plus 150 plus the beginning inventory, which is the 4,200. And then the year-end inventory using LIFO, what we do is we take the initial ones. As you have seen, initially we purchase 50 units and then 30 units and then 60 units. So we take the 50 out of the 65, you have 50 here and then 15 units here and the beginning inventory, which comes out to 3,400. So the answer is the last option. We have additional questions for practice, which I'll mail to you all later. Now let's move on to the next topic. Before moving on, I would like to confirm whether it's audible for everybody, whether there are any connectivity issues, whether it's good to go forward. Just respond in the questions or chat box. Okay. Okay, right. So this is the last topic that we have in our agenda. Till now we have seen how to value the different components of the income statements and use depreciation. Okay. Am I audible to you all? Please confirm if I am audible. Okay. Okay. Right. Now I'll move on to the earnings per share, which is the performance metric as I explained. There are two basic metrics here. One is the basic EPS, in which you have only equity shares in the company. And then the second is the diluted EPS, where you have equity shares plus other complex things, which are like debentures, bonds, which can be converted to common stock. So if a firm, the capital structure, the things that the company issues, those come under the capital structure. So if a company has simple capital structure, it has only common stock, non-convertible debt, and non-convertible preferred stock. However, if it has a complex capital structure, then it will have some potentially dilutive securities like options, warrants, convertible securities, etc. So if a company has simple capital structure, it needs to show only basic EPS. However, if it has a complex capital structure, it needs to report both basic and diluted EPS to measure the performance. Let's see what each of them mean. Basic EPS, basically the concept is pretty simple. What we try to do is we try to find earnings per share. Earnings or the income available to common stakeholders, which is in the numerator, and the denominator has the average number of outstanding shares available. So this way you can find out if you own a share in a company, how much you earn through that. The weighted average number of shares, that's calculated by the period, that's calculated in the period that you are dealing with. Diluted EPS, it's always lower than basic EPS. This is a point to be noted. And this diluted EPS, as I explained, is calculated when you have other dilutive securities like stock options, warrants, convertible preferred stock, convertible debt, anything which can be converted to common stock. Why do we calculate this? Because these have the potential to actually reduce the EPS of yours. So each dilutive security must be examined separately to determine if it's actually dilutive. That is, whether it is actually reducing the value of the earnings per share. There are some securities which can be anti-dilutive. That means they do not decrease the earnings per share that you get. They may actually increase the EPS. In such cases, we should not include them in our calculation of diluted EPS. So the basic formula that governs the diluted EPS is you have the net income that is available to you, you subtract the preferred dividends that is paid to the preference shareholders, you add back the convertible preferred dividends earnings, you add back the convertible debt interest, and you take care of the taxes using 1 minus tax rate. And then in the denominator you have the total number of common stock shares, which is the weighted average shares that are actually there, and then you also have the converted shares which you got through. Here's an example that will help you understand how we calculate these shares. Here's a company which has 10,000 shares initially. They issued 4,000 new shares on July 1st, and they issued 5% more dividends on the same day. And then they have some convertible bonds which they issued 100 convertible bonds, which are convertible to 15 common stock shares on September 1st. We assume that the convertible bonds are dilutive, and they asked us to find the weighted average number of shares to be used to calculate both basic and diluted EPS. Again, this is a kind of question that you can expect in the CFA Level 1 exam. And the solution to this, I'll move on because of the lack of time. The solution is pretty simple. It is B. And the way we calculate them are, we calculate the average number of shares, which is 10,000 shares. They are at the beginning of the year and they are for the all 12 months. So we take 10,000 completely. And the 4,000 shares that are issued in July, they are for 6 months and they have an extra stock dividends of 5%. So we take them as 4,000 into 6 by 12, which gives the weight, and then the 1.05 is the stock dividends that are additional to them. So we get 12,100. In case of diluted EPS, we'll also include the convertible bonds. We have 15 convertible bonds which can be converted. We have 100 convertible bonds which can be converted into 15 common shares, and they are issued in September, so we take 4 out of 4 by 12 to give 12,600. So that's it. That sums up what I have to discuss here. You can also look for these additional problems for your practice, which is based on the same concepts. I hope they will be useful to you, and I have solutions to them. I'll mail you this PPT. You can go through them. You can go through the concepts once again. I know there have been some connectivity issues. You may have listened to only part of my presentation. So I'll mail you the PPT. You can go through it and you can practice these questions. Finally, here are the other webinars that we have coming up, and we have already had one yesterday. The links for the blogs, quizzes and webinars are here. You can go to them, you can go to visit them. Today what I presented, understanding income statement, I have a blog which is a summary of basically what I told here. You can go through it. It will also help you. And then we have other blogs and quizzes that on our website, www.edupristine.com. Go to the blog tab and you can find all these blogs. And then tomorrow we have a webinar coming up on hedging strategies using futures. You can register using the link which is mentioned, and you can go through the blog and you can give the quiz. You have a lot of things to do that you can do. And you can also look forward to more webinars from our side on the topics of your choice. Just drop a mail to us to suggest a topic. Finally, what we have is, we have a lot of new things coming up. We have classroom training coming up in New York and other locations, which will be starting on May 2nd. We'll have a 4-day crash course on CFA to help you prepare before the CFA exam and the FRM exam if you are interested. And you have other webinars coming up next week and many more. Thank you for your patience. Signing off from my side. Thank you all. Let's meet later.